And the nice thing about GU and EU, by the way, obviously these both correlate fairly well with DXY, but these have the strongest correlation, Euro USD and GBP USD, of all US dollar currency pairs. For instance, you've got AUD USD and NZD USD. These two correlate. They are closely correlated. I would say Euro USD and GBP USD have a closer and a tighter correlation. And sometimes you will have setups that present themselves on one of the two, but not the other. For instance, this particular sell we were looking for on Euro USD, but we didn't get the retracement for it. If I pull it up side by side, you guys might be able to see this a little bit easier. So let's do that. Taking a look at the left side, which is where we actually structured a trade on GU, we had a fair value gap and an order block. All right. And notice my cursor on the right side of the chart on Euro USD. Okay. Notice my cursor there. There wasn't a point of interest that really made sense for us to take sells off of. Maybe you could take it off this order block, perhaps, but it wasn't as clean as GBP USD. So we took sells on GU and not EU. Prior to that, we had sells. Yeah, we had sells on GU. All right. If you notice the crosshair on the left screen, which is GBP USD, this was already at a low on Euro USD, and GU was at a high point in price. So there was a subtle divergence between the two, which are normally very closely correlated, which means that this point of interest was present on GBP USD, but not on Euro. And so we took the sells on GU as we traded back into this area. Whereas on Euro USD, when we were in this high, I mean, to be fair, there was like an order block here. Maybe you could have structured sells from, but it was cleaner on GU. So we look at both of these to understand, number one, the correlation, but number two, to look for the better setup, because sometimes the market will offer you a better setup on a correlating pair instead of the main pair that maybe you're used to looking at. So I have a whole cheat sheet here. I'm going to give this to you guys, but it's a list of all correlating pairs. Maybe, it can support your current approach and what it is that you're trading. Because now you know, oh, wait, there's a pair that correlates with this that I can consider and I can take a look at to see if maybe the other pair that you normally don't look at actually is offering a better setup than the one that you normally take a peek at. But this is the correlated pairs cheat sheet. So let's take a look at this. And this is, we're going to continue with the market outlook in a second. I'm going to share some other points of interest and stuff. But this is really key because, again, you will sometimes be able to find setups that are cleaner on one of these two pairs than the other. So you might not even know that there's correlation, pair correlation. Maybe this is the first time you're hearing about it, number one. Number two, you can also look for what's called divergence. Okay. Divergence is when you have two normally correlating pairs doing different things. And that is very, very telling as to what the market is going to do next. Because we're all traders, right? We make money or we lose money based off our anticipation of what's going to happen next. So any sort of an edge that we can get, we want to try and get to increase profitability, right? So one of those edges is pair correlation and pair divergence. So you can see on screen, Euro USD lines up with GBP USD. Euro JPY, GBP JPY, two correlating pairs. Euro CAD, GBP CAD. Okay, you can see that all of the Euro and GBP pairs are very closely correlated. Same thing with NZD and AUD. You then have gold and silver. Some of you have sometimes seen on stream where I'll look at silver. Normally, I don't trade silver, even if there's like a better setup. Okay, I'll just structure entries on golds because of tighter spread, number one. And then number two, the lot sizing is a little bit more favorable for us on PU Prime with golds as opposed to silver, and most brokers for that matter. All look at and consider the pair correlation because you will sometimes see what we call divergence between these two pairs. And that, again, is very telling as to what is likely to happen next. Then you have the indices, and all three of these correlate with one another. You have US 30 and which is the Dow Jones, all right? Also known as YN on futures. You have SPX 500, which is the S&P 500, also known as ES on futures. And then you have NAS 100, which is the NASDAQ, also known as NQ on futures. So all three of these actually correlate really well together. And you can again look for divergence across those three pairs. Sometimes you'll have one of the three that's doing something that the other two aren't. It's very telling. And I'm going to explain how in a second too, once I'm done sharing this with you guys. Then you got DXY, which is correlating with all US dollar pairs. You can see at the top here as well. You can actually look at the DXY equivalent for all other currency pairs. So 6C1 exclamation mark is the Canadian dollar futures ticker. You know, all that fancy jargon. Simply put, it's the Canadian dollar put up against a basket of other currencies the same way that the DXY is. So the DXY is the US dollar put up against a basket of other major currencies. Same thing with the Japanese futures. Okay, any Japanese yen pair is going to correlate and have a similar relationship to DXY's correlation to Euro USD and GBP USD. 6J1 exclamation mark, which is, I know it's a weird ticker, right? It's kind of bizarre. That is the futures ticker for the yen. Okay. That will have a strong correlation with any JPY currency pair. And so you can find the equivalent of these for all other currency pairs. I don't have them listed in this cheat sheet, but you can, do some exploring and find them. And then you got oil, US oil, UK oil, they correlate. I'm sure you guys probably get the point. I'm doing a really thorough job explaining this. Now let's talk about divergence. And this is the second cheat sheet I'm going to give you guys. Normally, correlating pairs have a strong correlation. Okay, they're doing the same thing the majority of the time. However, when you have two closely correlated pairs that are doing something slightly different, I'm probably sounding like a broken record now, that is very telling. It can tell you something about what's going to happen next. So a bullish divergence is when you have two correlating pairs, doesn't matter what they are, by the way. This could be gold and silver. All right, right now on screen we have Euro USD and GBP USD because they're two correlating pairs as an example. A bullish divergence is when you have one of the two pairs creating a higher low while the other one is creating a lower low. That is very telling, especially if it's inside of a higher time frame point of interest. Key point. And sometimes it'll just be happening on the higher time frame, and that holds even more weight because the higher the time frame, usually the more weight will be held in a divergence, the more significance it will have. So here you have GU, which is capturing liquidity, taking a low, but you have a stronger pair, euro in this case, which instead of capturing liquidity and going to create a lower low, is actually creating a higher low. Typically, the rule of thumb here would be to buy the stronger pair. If you were looking for a buy setup and you had a similar chart on GU and EU, similar points of interest, ideally you want to be buying the stronger pair, and looking at and identifying divergences like this will give you insight into which one is stronger. It's not going to be like a massive difference in most cases. Like it's not going to be like, oh wow, you know, instead of me catching a 1 to 3, I catch a 1 to 10 kind of, difference in strength. But it might be the difference between you taking a 1 to 3 risk reward ratio trade and you taking a 1 to 5 risk reward ratio trade, which is considerable still based on a divergence. So you want to be buying the stronger pair. If you identify that, hey, these two charts look similar, but one's creating a lower low at the same time as one creating a higher high, that's a divergence because they're not doing the same as the other pair. Hence diverging. They're diverging from one another. That can be very telling that, hey, we're about to see a reversal, and I want to be taking a position on the stronger pair if I'm looking for buys. Same thing, vice versa, in a bearish divergence, where when one currency pair is creating a lower high while the other one is capturing liquidity, creating a higher high, I would want to be selling the weaker pair. All right, if I'm taking shorts, I want to sell the weaker pair. So Euro USD would be weaker because we're creating a lower high. We're not seeing any sort of strength to go and capture this previous high. This is the weaker pair. Something to consider, okay? And I have, potentially more training I can deliver for you guys on this in the future. I just wanted to kind of do a thumbnail sketch for you all on correlation and divergence. And there's a very specific reason why every single Sunday we'll look at the same pairs at the same times in the same order. It's not, oh, it's just his routine. Donnie's back on the charts. He's looking at DXY first, then Euro USD, then GBP USD, then, gold, then Bitcoin. It's not random, and it's not just out of habit. It is by design and intentional. because the DXY is going to give me an outlook on what the other US dollar currency pairs are going to do, number one. And number two, I can then go to Euro USD and GBP USD and identify pretty quickly, boom, point of interest, boom, point of interest. Let me structure setups off those areas. And I'll consider divergence. Is it the main thing I'm looking for? No, it's more of like a tertiary confirmation. It's like the cherry on top of a setup. It's not the main thing. Keep the main things the main things, like order blocks, fair value gaps, market structure, liquidity captures. Those are the main things we look for. Divergence is on the back burner. It's something I'm going to consider. It's kind of like, I was going to say like seasoning, but no, seasoning is like, you know, that's a main thing that'll like make a dish. Right. So it's not divergence isn't really, like seasoning. That's not a great example. What's a good example? It's kind of like this. I think you guys are gonna like this. It came to my mind. It's kind of like a toaster. You got your bread. You're putting it in the toaster, right? And you have the setting for how long you can toast the bread. Now, if you like, have your toast set on 2 minutes versus 5 minutes, big difference. That's a huge difference. You know, Divergence is kind of like in trading when you have it set to 3 minutes and you move it just a little bit more to like 3.5 minutes. That's not going to make a huge difference, but it's still something you can do. And, maybe it's a little bit more to your taste. So divergence is not like the end all be all. It's not the main thing you want to be focusing on. It's just something in the tool belt that you can keep in the back pocket and pull it out when necessary. Like at the moment you're about to take a trade, after you have all your analysis there and all your confirmations, okay, this, and this are here. I'm ready to toast my bread and get ready to put my peanut butter and jam on it, whatever. Oh, let me take a look at the other pair and see if we have divergence going on. I'm about to take this trade. Let me see if I'm feeling like adjusting the knob to 3.5 today instead of 3 minutes on the toaster. And that's kind of like how it is. It's not a massive difference, but it could be, worth considering. Another point with divergence or pair correlation, write this down. I hope you guys are taking notes on this. You want to, when considering divergence, sell the weaker pair, buy the stronger pair. Number two, buy or sell the laggard. And what that means is basically the pair that is slower in approaching the point of interest. So Euro USD, you can see we're already at the 70, kind of kill zone area on the fib. The point of interest is here. It's at like the 786. GU, we're seeing a weaker approach. We're not at the 70.5 yet. That same fair value gap is all the way up at the 886. The laggard would be the pair that is slower in trading into the same point of interest. That is the laggard. It's the one that gets there second. If you sell the one that gets there first, you could still have a profitable trade. This could still be profitable and taking shorts from. That's why we're going to consider it. However, if GU is slower on the approach, what could happen is you could get a this is like you anticipating a divergence before it happens, where Euro USD could very easily go and sweep these highs while GU is just on its way up to the same fair value gap, and we respect this high. So instead of you taking a sell maybe prematurely on Euro USD as we're trading into the point of interest, because we're acknowledging that, hey, the same point of interest on GU is still 40 pips away. Euro is like right there. Like we're basically in the point of interest. I might want to consider sitting on my hands and waiting for GU and then taking shorts on GU because GU is slower, therefore it's weaker with some exceptions. But instead of me taking a losing trade on Euro here, potentially taking it too prematurely, I'm waiting for the correlating pair, which still has a ways to go. And the likelihood of us trading into the zone and then getting stop hunted would be way less likely. Are we having some fireworks going off in at least one person's mind right now of like, oh my gosh, why haven't I been considering correlation and divergence? Why have I not been considering the relationship between two closely related pairs to, one, be taking a position on the one that is likely going to be more profitable with a stronger move, and two, avoiding positions that might be too preemptive when the other pair is still a ways away from the same point of interest. Is this resonating? Or am I just huff and glue over here? Hopefully this is I don't know, man. I don't know. These market outlook sessions are meant to be market outlooks with like a bit of training mixed in. And this is like, I would say an advanced concept, right? This is not beginner stuff. If you're on this call and you're like, Donnie, I am freaking confused right now. I totally, I totally feel you. Like the first time I was introduced to this, I felt the same way. And then after I watched the recording of the session that I learned this same info on that I'm giving to you guys right now, after watching the recording of that session a few times over and over again, that's when I had my aha moment, started to apply it and back test it and actually forward test it as the market was developing. And it completely changed the game for me with my trading. Eric, great question on the fib. I think in an effort to be mindful of time, I won't go over it today because it's a bit of a longer lesson. We'll save the fib training for another day because otherwise we would be on here for like another hour.